Hello, welcome to Legal Action. My name is David Siegel. I'm joined by my co-host Jesse Variantes. Jesse, welcome.
Thank you.
Today we're going to be talking about the current trend in the real estate market. The state of the market is a little bit in flux right now where nothing is moving. There's a lot of product on the market. We're going to be talking about that in conjunction with the current mortgage foreclosure crisis issue. Jesse, let's start basically with the home buying process for those that are still eager to tackle this during this tough time in the market. What's the first step we need to do as home buyers in terms of getting into that house?
Well, there's a lot of things that you can do. Sometimes people, what they'll do is they'll go to their bank, people with good credit, and get pre-approval for a certain amount of money. That's very good because sometimes, if there are competing bids on a house, a potential seller will go with somebody who has been pre-approved. That doesn't mean that you have it. It just means that you're pre-approved. There's a whole bunch of other stuff that you have to go through. But you may want to get a realtor, somebody who's been around for a while, somebody in that area. And they'll take you around and show you and find out kind of what you're looking for, what you want. It's
the other option would be to go look for buy owners.
You could do that too. I think the way we found our house was we drove around and we saw a sign outside and we kind of looked at it and explored that and some other stuff. So that's possible too if it's for sale by owner.
But for a novice, a first-time home buyer, probably the best thing to do is to get the advice of a realtor who can let you know what houses are available, the difference between the houses, what the market rate is for comparable houses. But you can't do that on your own, can you?
That's right. No, and especially, again, as you say, for first-time home buyers, and especially if you're buying it, you're not going to pay commissions to the seller. So nothing's going to come out of your pocket with respect to that commission that's going to be paid to the real estate agent. So you need to find somebody. Again, it's important to get somebody who's kind of local or somebody who knows that specific area where you're looking. I would suggest just look all over. Just don't, unless that's the house and it's it and that's what you want. You need to look and see because believe me, and we'll talk about that a little bit later, there's a whole lot of houses out there.
Right. And try and find a realtor that's aggressive and active and pursuing these houses for you and staying in contact with you because there's nothing worse than signing up with a realtor to show you around and they're showing you very little property and they're never available. So you want to make sure that they're aggressive and they get the right house for you. They know what you're looking for and they try and find you that exact product. And there's plenty of product out there right now.
Oh, there sure is.
All right, so you find the right house. We have to talk about a contract, don't we?
You find the right house, right, and then you make an offer, and there'll be a real estate contract. And again, it's negotiating, goes back and forth. They'll have it placed for whatever amount. Let's just say $300,000, just use for an example, and that's what it's listed for. And so maybe you'll come in a little lower because people anticipate that offers are going to come in lower. So sometimes, and that's why you need a good realtor, somebody who understands what the value is and how much where they can put it up to get the best bang for your buck. I mean that goes either side, seller or buyer. So
what are the most important issues in the contract?
Well, what you want to be very aware of when you go through the contract, you're going to have, well, of course, the price term. You're going to,
because very importantly, that's the one item. Once the contract's accepted, that cannot be changed by the attorneys.
That's correct. And we'll talk, there's a modification period. Well, we'll just go directly to that.
Okay.
After the date of acceptance, there's 5 business days that either party has to make modifications. Anything except, as you said...
And this is the attorney approval period?
That's correct. That's correct.
That can actually be shortened, correct?
It can be by agreement. It can be shortened. It can be waived. It can be, anything you want to do. By
typically 5 business days.
Typically 5 business days. And what also goes along with that is your period of time for inspection. Now that's different. In the contract...
No, hold on. Is this inspection? Is this you walking through the property by yourself and just making sure that all the lights are working? What's involved in an inspection? It's a little more complex, is it not?
It's getting a licensed inspector, and I'm very sure that a realtor will have a couple of referrals for you to do that. Generally, it can cost anywhere from $250, $350. It just depends on the size of the house and some other variables.
But sometimes realtors have an inspector in their database that they know is easy, and that's not going to kill the deal and not going to find a lot of violations. Have you heard of this?
That's true, too. It is as well. When people come to me, I give them the option. I have somebody who who I work with for a long time and who spends an awful lot of time, about 3 hours going through everything.
Right.
And so, I tell them essentially the same thing that you've indicated, basically, hey, I don't know if they have any type of relationship, but I do know that this person does a great job, and he's done a great job on some other things. So,
yeah.
And I leave it up to them.
You want someone who really is going to point out the defects, even if they're small, because as the future owner, you can still make that decision to not make a huge deal of it and buy the house as is or with certain modifications, but you don't want to have things overlooked and then find out later that, hey, you got a cracked foundation that a better inspector would have certainly found.
Right. That's correct, too, but you understand, and generally the liability for inspectors are limited just to the amount that you pay for it.
Yeah.
But also understand, it's an inspection, all right? And, if you get somebody who's experienced, that's fantastic. They'll look for those kind of things. There'll be telltale signs. For example, in the basement, they want to look to see if there's any water damage, anything that's been, up on
I know you've handled cases before where the water in the basement was not disclosed by the prior owner.
That's correct.
Which it must be disclosed pursuant to the Disclosure Act.
Right, Residential Real Property Disclosure Act, exactly. We've done those, and, those are no fun for anybody because they're going to cost, any litigation takes a lot of time. That's also part of the contract, too, to disclose those kind of things, and you want to make sure that you look at it very carefully and go down. There's a checklist of things, and if there is and that's what I tell people, if you know, on the selling side, if you're aware that anything's been done, that you've had any water or crack, you know what? Disclose it. Believe me, it's going to be a whole lot better now. You disclose it now than have somebody like you or me coming after them later in litigation, and it's just going to cost more money. You just disclose. Just tell the truth.
So we've got our price, we've got our contract, we have our inspection. We may or may not have financing at the time. What happens next?
Well, we wanted to talk about some of the other terms in the contract. One is the mortgage contingency date. Even though you might be pre-approved, you're still going to have to be able to get your documents into your bank that they're going to request. They're going to request paycheck stub, taxes, income, asset statements, all different kinds of things. They're going to look at the history. They're going to look at your bank accounts. I mean, that's why it's a good idea, especially if you have good credit, to go to the place that you already bank because they already have a history for your bank, account activity and all that kind of stuff.
Well, this is the biggest purchase that most people make in their lives. It's the most amount of money that they owe in terms of financing over the course of their life. So it's really an important step to make sure that the financing not only is in place and that you qualify, but that you know what you're getting into. What should people look for when they're dealing with the financial end and the mortgage end?
Well, if they're looking for, it just depends on your situation. What is your intention for the property? Are you going to stay there for 3 or 4 years or 5 years and then, go someplace else? Are you, planning a family to expand? Or do you plan on staying there for a while? And then you want to look at the different packages that are out there.
Let's assume the people are planning on staying for a very long time.
Then probably best bet would be to get a conventional 30-year fixed rate. What's great about that is that it is what it is. It's fixed rate, or whatever that rate is that you have. And if your credit's good, sometimes they offer incentives. And if you get that percentage, because it's not going to change.
Have you seen a lot of people go with the GSEs, which is Fannie Mae, Freddie Mac, government-sponsored enterprises?
Those are the more difficult loans or more difficult closings that I've kind of had. And they have programs for other people that are out there. There are other requirements that they have as well. And for the home seller, they have to jump through sometimes a couple more hoops because they also have inspection requirements and other things.
Okay. Should they use a mortgage broker, or should they go down to the local bank on the corner and say, what can you offer?
Well, I think it's important for people to search out the best rate. And typically, if you have good credit, there should be no reason why you can't go to your bank and get a competitive rate.
There's an old Motown song that says, you better shop around.
Yeah, you better shop around.
It used to be back in the day, the only place you can go was the bank on the corner, until the mortgage broker industry came about and the government decentralized the financial end of real estate buying, where now you can get options. There's not just one loan program. So there's a lot of choices out there in terms of adjustable rate mortgages, non-conventional subprime, no documentation loans. What do you do?
Well, I mean, again, we're assuming it depends on what situation you're in. If you're somebody with good credit, you're going to be okay. I mean, it pays to shop around, and that's good. But in my experience, you do get what you pay for, all right? And with the bank that you've done business with all this time, hey, you can be fairly assured that things are going to go probably smoothly. You can go to a broker, and that's fine. And you know, it's just like any other profession. There are good and there are bad. I've had a lot of broker deals that you know, that weren't so good. I've had some that were fantastic. You know, it just depends on the specific situation. But generally, in my experience, people go to brokers because they don't have the credit options. Their credit is not as good, and consequently, their bank won't lend them any money. And so then you're talking about, you know, subprime PNC paper where, you know, the requirements are a little bit lax, but that means also the interest rate is a little bit higher.
And you talked about this mortgage contingency clause.
Right.
Meaning if the person doesn't have the ability to obtain financing at a certain rate or a certain dollar amount, they can actually cancel the deal and get their earnest money back. True?
That's correct.
Now let me ask you this. Why would somebody go into all the hassle of looking for property, putting down the earnest money, hiring an inspector, hiring an attorney, going through all these steps if they don't have the ability to buy the house?
That's why it's important.
Who are they fooling?
Well, that's why it's important before you go in to try to get pre-approved. Before you go in, if you're one of those people who don't have good credit, you know, to try to speak with somebody else, a broker or someone.
Yeah. The reason why I mention this is
Right.
the seller's going to like to know that you're pre-approved when
Sure.
they're negotiating the sale price.
Right. Because it's going to tie up the property for at least a month, maybe two. Generally, you know, we'll have the mortgage contingency date about 30 days or so out. It depends. Sometimes people are in a hurry to sell, and so we shorten that, and you know, we try to stay on top of everything to make things go quicker.
I liken this to someone who wants to buy a new car, and they go to the dealership, they test drive all these cars, and they don't have 2 dimes. Okay, they can't afford the car, they're just fooling themselves. And people do that with real estate too. They walk through a lot of houses, and you know, I'd like to live here, but they really can't afford that house.
That's true. I mean, you know, that's why a good real estate agent will be able to kind of see these kind of things, because real estate agent is you know, that's his profession. That's his living. That's what he does too. And you know, if the finances don't flow together, you know, it's probably not going to work so well. But you will lose your earnest money.
Okay. Let's assume they do qualify for the mortgage.
Right.
And all the other checklist items that we've talked about previously
Right,
have been satisfied.
You've gone through the attorney approval, the inspection period time, and you know, let me just back up 1 second. With the inspection or the attorney approval, you can make requests. If they find some things that are that's not right with the house, or there's a crack, or you know, some things that you're not satisfied with, you can negotiate and request during the modification period for the other side, the seller, to either fix those things or give you a credit at the closing off the price so that you can fix them yourself. Right. And sometimes that's also a negotiating process, but also understand too that when you do that, it's construed as a counteroffer, and that can kill the contract.
And a lot of these items have to do with how much demand there is for that house.
That's correct.
If the seller has not entertained any offers in the past, you stand in a good position to start demanding either a credit or changes.
Right. He's more likely.
But if there's a bidding war on this property, and believe me, that's not happening in this market, you want to be a little careful that you don't want to ruin the deal by being too demanding, especially if it's a minor defect.
That's correct. And, you know, little things, for example, you know, window pane or, you know, roof even. Although roof is a substantial kind of deal, but I've had some situations where it was exactly that. There were other people interested in the property and were willing to offer more money, and so the client decided not to do modification. But anyway, since we're through all that period and everything else, and now your mortgage contingency, it's very important again to hire somebody who does real estate, somebody who's cognizant and who's aware and who's done it before, because those deadlines are crucial. If you blow the mortgage contingency date and you don't have an unconditional mortgage, then what's going to happen is, with respect to
in theory, what you have, or in practicality, you have a cash deal.
If a cash deal is different, then there's no need to do a mortgage contingency, because if it's all cash, then there's no need to go through lender.
If you pass the mortgage contingency and you haven't obtained financing, then you're technically under a cash deal at that point.
Well, what's going to happen is if you don't, if you can't make the deal close, then you're going to lose your earnest money. Exactly, and that's what that's designed to protect, because the process takes, like I said, about 30 days or so, just depending. And if it falls through, it gives you a way out.
How much is earnest money? We've mentioned that a couple times, and
Sure.
I know that varies case to case, but what's a typical earnest money amount, percentage-wise, on a piece of property?
Well, I mean, typically, I've seen anything from $1,000 to $3,000 to $5,000 and $10,000. It just depends upon the price of the property. Now, if you want to show that you're very serious about the property, okay, you'll give a higher earnest money, but also understand that if something goes wrong, that's going to be in jeopardy. Even if you're entitled to have it back, okay, and they're not very often, they're not just going to hand it over to you. What it's going to require you to do is to go and file a lawsuit or small claims or whatever in order to have the other person or to have the escrowee. Generally, it's held by the listing office.
Well, if each party has competent counsel,
right,
cooler heads are going to prevail, and they're going to return that earnest money unless the contract was complied with.
Right, you would think. I mean, but sometimes there are difficult clients, and the clients don't want to don't want to turn that go. Sometimes there's a fine line question of, hey, we had an unconditional mortgage commitment, and actually when I say that it's unconditional except with respect to matters of title and matters of survey, which generally don't happen until the end. So I mean, it's conditional in that respect, but there are other conditions they can place upon it. So we always look for something that's clean, as long as it's not the kind of standard stuff.
Okay, well, let's move forward here. We've got the financing in place. The attorneys are happy. We agree on the price. We've passed inspection. When can I get in this house?
Well, now we talk about the finance end of it. As long as you're the lending institution, loan officer, and the processor have done their job, and it's very nice to have people who do their job well for the closing date. In your contract is also a closing date, which is there's generally no time. It's generally by agreement, and it's closed in the title office that's closest to the property, unless it's by agreement. You can move that closing date forward or backward, depending. And so, let's say everything's done, we have all the paperwork, and there's nothing left to do, and both parties want to move it back. If it's by agreement, you can. But again, it requires notifying the lender, because then they're going to have to process it. Everything gets, gets calculated right up to the date of the closing, because the prorations for taxes and for everything else.
Well, let's talk about this additional paperwork that has to be done once we have an agreement that's solid. Somebody has to order title and make sure that we're buying a clean piece of property, correct?
That's correct, and that is generally the seller's attorney.
Oh, so the buyer's got an easy job there, huh?
Buyer doesn't have to worry. Although there are some places, because they have, like anything, is taxes, right? There are state taxes, county taxes, local taxes, even for the municipalities, and so you need to find out from the municipality, what the requirement is, and not only what the requirement is, but who is it, a seller charge or a buyer charge? Sometimes local municipalities will charge 50 cents, $1.50, $1.75 per thousand. So you just take ever the purchase price is, multiply it times whatever their charge is, and then you get that, and then you have to get transfer stamps from them, in order for it to go through. But sometimes it is a buyer charge. And that's where a realtor really comes in, who knows the local area, really comes into play too, because that person will have experience and he'll be able to tell you, hey, listen, you're going to have to. But that's also what your attorney should be telling you too, right? That's what you're going to have to pay as well.
Let's fast forward, if we will, to the actual closing table.
Okay.
There's an entirely huge set of documents that are going to be submitted for signature by both parties, but primarily for the buyer who's signing mortgage documents.
Right.
How is that handled? Who explains those documents? Who takes the time to read those documents?
The attorney explains it. The buyer's attorney explains it to his client. And those documents, the closing package, it comes from the lender. Now, sometimes they are indeed very thick. Sometimes people do more than one loan. They do a first and a second. And so now you have two documents that are like this, and they're essentially, they say the same, it's just with different amounts. So you can get through that, but it still requires signatures and initials and all those kind of things. But again, it does come from the lender, and sometimes packages. I know when we did our closing, there were probably stacked like this, not very many, which was was very, very pleasing. So the attorney will explain the documents. Now, as a purchaser, all right, you should know what your deal is with your lender. You should know exactly what the terms are, exactly what it is, and so when you go through those documents, you're going to want to make sure that you specifically check out exactly, hey, listen, that's the rate I agreed to, that's fine, there's no points, there's no, prepayment penalty or anything like that. So you want to be aware, you want to be more involved. A lot of times people don't. They just, they'll just sign anything.
It's possible you want to get those documents in advance so that you have time to review them, but it's not always possible.
No. In fact, it's rare even. Generally, you see those documents for the first time at the closing table.
Well, here's my concern. You've got a series of mortgage documents in front of you.
Right.
You've got all kinds of disclosures that as a first-time or second, whatever home buyer you are, you want to read and you want to make sure that you know what kind of rates you're getting, if there's any kind of points, what the amount being financed is. And then there's certain federal disclosures under the Federal Truth in Lending.
Correct.
And the good faith estimate that was given to you that you're going to look at again. Those are actually in place to protect the buyer. But in fact, when they get buried in 50 pages of documents, all they really do is cover the tail of the lender. They do the exact opposite of what they're supposed to do because the buyer is just overwhelmed with the amount of documentation they have to read that they don't see the important disclosures. And they're trying to change that. There's congressional activity right now that's trying to consolidate some of the important documents into 1 or 2 pages that will show what the rate is and what the amount being financed is and whether there's any points, whether there's a prepayment penalty. So there are some changes in the works because the homeowner, the buyer, is really not getting the advantage of these disclosures. They're getting confused by them, and they're getting buried in a big mortgage package. Any thought on that?
Well, I mean, it's definitely true. When you're hit with a stack of paperwork that thick, and the attorney isn't going to read the documents through for you, okay? He's going to look at them because he's done closings before. You have a real estate attorney, somebody who's done that, who's cognizant, and he's going to explain, okay, this is the disclosure, this is what this is what that is. And a good attorney is going to go through those things with you specifically. But again, you're seeing this for the first time. I mean, the long and the short of it is, if you don't sign every paper where they want you to, an initial where they want you to, then guess what? You don't get the loan.
Right.
So, I mean, whether or not I explain it or not, okay, do you want the house? Do you not want the house? It would be nice if the packages were smaller. A lot of times we see duplicative type of documents, and it's the same again and again, and so that would be a welcome change.
My concern is this: there's 50 million loans out there right now in the United States. 10 million of those loans are subprime, non-conventional loans, meaning there's some form of adjustable rate mortgage, things like that. Have you ever, in the closings that you've done, ever seen a document at the closing that showed what the current rate is and what the payment is, and then some proposed adjustments in what the future payment will be? Because I've never seen that. Have you?
Not particularly.
So the buyer really doesn't know exactly what the dollar amount of the future mortgage payment is going to be when the rate adjusts and resets.
If you have, because earlier we were talking about a conventional, but if you do have an adjustable, yeah, I mean, but here's the problem with that is you're not going to know because a lot of times it is, it's tied to prime. And so it depends upon the condition of the marketplace where that's going to go. It's going to go up, it's going to go down. I'm not a big believer in things going down, okay? Things generally don't go down, they go up. They may go down, and that's great, that's fine. But, again, it's tied to prime. That's something that you really can't do because you don't know what the market's going to bear, in the future. 2 years, 3 years, 4 years, who knows? And so all you know is that it's tied to prime generally, and when that fluctuates in its time, that's your payment's going to go up.
Yeah. In a recent study, the homeowners, 80% of the homeowners had no idea what their mortgage payment was going to jump to, and that's scary because a lot of people are just eking in by the skin of their teeth to make the current mortgage payment at the low introductory teaser rate. When they actually see the jump, and it's anywhere from $200 to $700 on average for a typical home loan in the United States, that's an insurmountable amount to pay without getting a second job.
Well, true, but I mean, here's the thing. Here's the tail of the tape here, okay? That means, conventional. We talked about that earlier. Conventional. That means you know exactly what it's not going to change. The only way that would change, and there are some caveats, it's not going to change because your rate went up. It might change because the taxes on your property go up or your insurance goes up.
And they certainly do go up.
Right, and they escrow. So part of your payment when you make the mortgage payment, if you're escrowed, and I highly suggest that you do escrow it. Many people aren't disciplined enough to be able to take the extra money and put it away. And what happens is their tax bill is due, and oh my gosh, I've got to pay this chunk of money, and they don't have it, and then that causes another problem. So it's much better off to be escrowed. And so portion of the money that you're paying is, well, in the beginning of your loan, a large portion of the money you're paying is going to what? Interest. Exactly. Which is deductible. So that's kind of a good thing. And then there's a very small percentage in the beginning of your loan, very small, that goes to principal, right? That's the amortization, the schedule we're talking about. Some of that money, too, is going to be applied toward the escrow account, and there are escrow disclosures in the big packet of things that you're going to have, is going to be applied to the taxes, and is going to be applied to the insurance. If taxes go up, and it kind of sounds like, at least in Cook County, they certainly are, then guess what? Then your payment's going to go up too, because they have to cover that difference. So I mean, that's different. The rate isn't going up. With the conventional, at least you know what your rate is going to be. Now, if you have one of those adjustables, then unfortunately, you're stuck. You don't know. And if it goes up beyond beyond something you can pay, then you're going to have a problem. In fact, Dave, there's a lot of foreclosures going on.
There's a ton of foreclosures.
What and these kind of foreclosures are what based upon what kind of market?
What happened was the lending standards were reduced to the point where people were able to get introductory rates with no documentation or little documentation, and they were able to qualify for loans that they probably would not have been able to qualify for 3 to 5 years prior. And what's happening is a lot of those loans with the adjustable rates are starting to reset. A lot of 2-year, 28-year loans. So in other words, the first year or two, the rate stayed extremely low. And then after that, the adjustable rate kicks in based on the prime plus a certain amount factor. And those are the amounts that they can't pay anymore. And a lot of the homeowners are losing their properties because they just can't make the current mortgage payment after it has adjusted.
Were those the teaser rates that you're talking about?
Those were the teaser rates. Those were people who didn't necessarily document that they had the ability to pay for those loans. And the big issue is the loans are just starting to reset now. They're going to be resetting in the next year to 2 years, and the government expects over 2 million foreclosure cases in the next 2 years. And this is going to cause a glut of inventory on the market. It's going to make it more difficult for people who are not in foreclosure to sell their homes. It's going to bring the value of the homes down. We're already seeing that. We're seeing a stagnant level in this area. And ironically, this is all happening when interest rates are historically pretty low. So we've got a real problem here. We're going to have a glut of homes on the market and not enough buyers. So it's a good time to rent.
Yeah, well, I can tell you that I was in the Chancery Division in DuPage County a week or so ago, and I can tell you, if you look at the call, 75, 100, foreclosures, boom, boom, boom. They're, and this is just every day. I mean, there definitely are. There's a lot of distress. I mean, that doesn't do good for anybody. Obviously, not the homeowner. Doesn't do good for the lender. Doesn't do good for the economy.
It's going to hurt everybody because a lot of these loans are sold and bundled as securities. So they're investment vehicles. And what's happening is if the interest is not being paid by the homeowner, interest is not being paid to the investor. Therefore, the market suffers. And when the market suffers, everybody suffers because all the mortgage packages are going to drop. It's going to be much more difficult for people who don't have good credit to qualify for programs because there's just not going to be any programs. It's going to be conventional only. So it's an interesting time, but not a good one.
Well, are there any incentives or anything, congressional or?
Well, there's some activity right now. We'll have to stay tuned on that. We'll update that on a future show. But thank you, Jesse. Thanks for being with me and talking about real estate. We'll catch you next time on Legal Action. Take care.
Yes,